Great. We'll just wait for 2 more minutes so we can start Facebook Live.
A small note to everyone joining in. We're waiting to upload our webinar to Facebook Live. Once our webinar is uploaded to Facebook Live as well, we'll be starting. So we expect to start in 5 minutes from now. A small note to everyone joining in. We are uploading our webinar on Facebook Live, and we will be starting shortly in approximately 2 to 3 minutes.
Well, we're now live, so we can start.
Sounds good. Assalamu alaikum and welcome to all those attending this panel. My name is Muhammad Usman Umar, and I, along with Asma Asrar Safi, will be serving as chair of Harvard-Pakistan Forum 2020. The topic for today's discussion is the macroeconomic situation of Pakistan in the context of COVID-19. In particular, we intend on exploring what Pakistan's path to economic recovery will look like. Shahrukh Taqi and I will be moderating this panel. We would like to start off by introducing our esteemed panelists. First, we have Dr. Raza Bakir. Dr. Raza Bakir is a Pakistani economist who currently serves as governor of the State Bank of Pakistan. He is an 18-year veteran of the International Monetary Fund and previously also worked at the World Bank. He was head of the IMF office in Egypt and senior resident representative from 2017 to 2019. He has also held positions as IMF mission chief for Romania and Bulgaria, division chief for the IMF debt policy, and head of the IMF delegation to the Paris Club. Having completed his undergraduate education from Harvard University, Dr. Bakir earned a doctorate in economics from the University of California, Berkeley. His research has been published in top journals of the economics profession, including the Journal of Political Economy and the Quarterly Journal of Economics. Next, we have Dr. Ishrat Hussain. Dr. Ishrat Hussain is currently advisor to the Prime Minister on institutional reforms and austerity with the status of federal minister. He has earlier served as Dean and Director IBA, the oldest graduate business school in Pakistan between 2008 and 2016. He served as the chairman, National Commission for Government Reform for 2 years from 2006 to 2008, with the status of federal minister reporting directly to the President and Prime Minister of Pakistan. He was appointed to the governor of Pakistan's central bank in December 1999. During the next 6 years, he implemented a major program of restructuring of the central bank and steered the reforms of the banking sector. As a member of the economic management team of the government, he played a key role in the impressive economic turnaround of Pakistan. In recognition of his meritorious services, he was conferred the prestigious award of Hilal-e-Imtiaz by the President of Pakistan in 2003. The Banker magazine of London declared him as the central bank governor of the year for Asia in 2005. The President of Pakistan has conferred upon him the highest civilian Award of Nishan-e-Imtiaz in 2016 for his outstanding public service. And last, we have Mr. Adnan Afridi. Mr. Adnan Afridi is currently the Managing Director of National Investment Trust Limited. He also serves as Director of Bank Al Habib Limited, Bulk Transport Company Private Limited, and Mari Petroleum Limited. In addition, Mr. Afridi is Chairman of the Board of Governors of the Kidney Center Institute and is a member of the SECP Policy Board. He graduated with high honors from Harvard University with an undergraduate degree in economics and a JD from the Harvard Law School. He has over 23 years of international experience in change management, business transformation, innovation, and profitability enhancement in blue chip companies, public sector, and startup situations. His functional experience focuses on governance, strategy, negotiation, and corporate planning. Previously, Mr. Afridi was a director at Silk Bank Limited, Gul Ahmed Textile Limited, and Trading Corporation Pakistan. He has also served as CEO of the Karachi Stock Exchange Limited, CEO of the Tethyan Copper Company Private Limited, and CEO of the OICCI. We would like to extend our deepest gratitude to the panelists. It is truly a privilege to be hosting you today. The panel discussion will be divided in three portions. The first portion is going to deal with the macroeconomic situation and responses so far. The second portion will delve into the economic outlook and what we expect the next couple of months to look like. And then the third portion will be a question and answer session. Here, we encourage all the audience to send in their questions as the panel progresses, and we will try to address them at the end of the panel. With that, I would like to hand it to Shahrukh to set the context of the discussion.
Thank you, Usman, and Assalamu alaikum, everyone. So Pakistan before COVID 2019 was on track to improve some of its fundamentals. Inflation was slowing down in 2020, exports were gaining momentum, current account deficit reduced significantly, and state bank reserves were steadily rising. And yet, some important structural issues remained unaddressed. Real GDP growth had slowed down significantly in recent years. Pakistan's consumption was extremely high. Pakistan's private saving levels were at an all-time low, with foreign direct investment filling in for a small amount of investment levels, with majority of FDI being market-seeking instead of being efficiency-seeking. Ambitious tax revenue targets were said to be missed, and IMF targets for public education and healthcare spend only had 74% achievement in the Q1 of 2019 to 2020 year. The COVID-19 pandemic, while primarily a health crisis, is having a substantial impact on Pakistan's economy. This crisis is unique since Pakistan, like the rest of the world, will experience both demand side and supply side shocks. And there is no playbook to deal with the double crisis. As a result, Pakistan's near-term economic outlook for fiscal year 2020, as per IMF, has worsened considerably, with growth estimated at negative 0.4%. Now, thankfully, Pakistan seems to be coming out of the health crisis, but it is unclear what Pakistan's economic recovery would look like. Now with that, we will go into the first stage of our discussion, that is Pakistan's macroeconomic response so far. And here, we would like to invite Dr. Raza Bakir. If you could please spend a few minutes on how economists deal with such a double crisis of supply side and demand side shocks. And as State Bank Governor, what are the key levers or policy options available to you, and how do you think about using these?
Bismillahirrahmanirrahim. Thank you, Shahrukh, and thank you, Usman, for the invitation to attend this event. And let me at the outset say that it's not only a great honor to be at this event, especially an event of one's alma mater, but it's especially an honor to be here in the presence of my predecessor, Dr. Ishrat Hussain. whose time at the State Bank of Pakistan is recognized widely as one of the best periods that the State Bank had, both externally as well as internally in terms of institutional reform. So it's a double honor for me to be here today. In answering your questions about how Pakistan's economy has been able to cope with COVID, and particularly from the macroeconomic perspective, I want to make 3 points, Shahrukh, and these 3 points are the following. First and foremost is that COVID has interrupted, but it has not derailed the economic reform program that was successfully started in the middle of last year. That's the first point. The second is that faced with COVID, the authorities, both the fiscal as well as the monetary, gave a swift, tailored, and aggressive policy response. That's the second point. The third important point is that whenever economic policy managers give an aggressive policy response, some can always wonder if their buffers have been depleted or their vulnerabilities have risen. And that is not the case. And we are at a stage where we are well poised for economic recovery. Now, I want to illustrate these 3 points by a couple of slides that will help to make the point. And the first slide that I want to share with you is about this point about how pre-COVID, the economic reforms that Pakistan had started were strengthening our fundamentals. And as many observers would be aware, there are 2 key culprits of why Pakistan had to go to the IMF and undertake a tough adjustment program. First was the current account deficit, and second was the fiscal deficit. The point I want to make is that there was a notable improvement on both of these 2 sources of our problems before COVID. The first, the current account, is illustrated in this chart, which in red shows the monthly current account deficit that Pakistan has had, and just focus on that for a minute. And you will see that in the middle of 2018, just before the current government assumed office, this monthly current account deficit was at an all-time high of $2 billion per month. Never in our history did we face such a drain on our foreign exchange resources. And you will see that steadily that deficit was reduced. And one of the key policy levers that was used to reduce it was the exchange rate, because as the exchange rate adjusts, and particularly adjusts from its previously overvalued level, imports become more expensive and therefore they become less. And exports earn more for any given dollar sale, and therefore they become more attractive. And that in turn pretty much is the current account deficit. So you see a striking relationship between the exchange rate in blue, which is expressed in real terms, and the current account deficit, which both move together. And if you look at the very end of this chart, you will see that the non-oil current account deficit has actually turned into a surplus. So the current account was improving significantly before COVID. The second key problem area was the fiscal. And here you will see that because of impressive, ambitious fiscal reforms, the fiscal deficit had shrunk to around 3% in the first 9 months of this fiscal year. And in fact, if you look at the primary balance, which is the difference between the revenues and expenditures excluding interest expenditures, which is not in the control of the government, you'll see that it had actually turned into a surplus for the first 9 months of the year. So my point here is that pre-COVID, the 2 key problem areas for Pakistan, the current account and the fiscal account, were showing demonstrated improvement. Adjustment which produces this improvement is not easy. If it were easy, it would be done on a timely basis. And here, the credit goes first and foremost to the Prime Minister, who gave his economic team the backing to undertake such difficult reforms. Belt tightening, whether it's on the fiscal side, whether it's the transition of an exchange rate system from a fixed and overvalued system to one that is market determined, and so on. And the credit goes to our economic team led by our finance minister, who led the negotiations with the IMF and others to be able to put the economy on a sound footing that it could address these twin imbalances. Now, in response to the crisis, which is the second point that I want to make, Pakistan gave a swift and aggressive policy response. And first is the government's response. And government had to carefully weigh two considerations. One, to give a significant response, but second also was constrained by the high level of debt. And unlike advanced countries, which don't have to worry about credibility, emerging markets, particularly those which have inherited high levels of public debt, do. So the government had to be careful, and it focused on some high quality measures such as cash transfer programs, procurement of commodities in the agriculture sector, accelerating refunds and others, and perhaps Dr. Ishrat will talk about some of these and other measures done by the government. I'll focus here on the measures done by the central bank. And the one that's spoken about most common is interest rates. And in this chart, we are sharing with you the actions of reducing interest rates and giving a monetary policy stimulus. And as you will see, the cut that was given by Pakistan of above 600 basis points is actually only second to Argentina, but Argentina was in the midst of a sovereign debt crisis. And even amongst those emerging markets that started COVID with double-digit policy rates, Pakistan's monetary stimulus by way of interest rates was amongst the highest. And you ask, Shahrukh, what does this mean? How much impact did it have on the economy? And I want to show you in rupee terms that if you translate into what was the net savings in the cash outflows of households and businesses on loan interest, that figure comes on an annual basis to 470 billion rupees. But this was not the only response taken by the state bank. An equally important, if not more important response was liquidity measures. At times of crises like COVID, a central bank has to use both interest rates as well as liquidity measures, and the same is being done in other countries. And in partnership with the banking sector, the state bank introduced a policy measure by which there was a presumptive extension on principal component of loan repayments by 1 year. The magnitude of that in terms of the volume of payments extended beyond the current year is a very large amount of 642 billion rupees. This is 642 billion rupees that households and businesses would otherwise have had to pay to banks, especially at a time when banks are becoming conservative and are wanting to conserve their asset quality. The next key measure was a facility and regulatory incentives given to those borrowers who were illiquid, not insolvent, and needed interest rate restructuring. And that amount comes to a very large amount of 170 billion rupees. Another important scheme introduced by the state bank was what's known in common parlance as the Rozgar scheme, or in other words, the payroll and employment protection scheme, which provided subsidized credit through refinancing to any business that committed to not lay off its workers for 3 months, and then it was extended for another 3 months. And under this scheme, another 138 billion rupees at a concessional amount was provided. So if you add all of these up, you will see a total improvement in net cash outflows of households and businesses of about 3.5% of GDP, or about 1.4 trillion rupees. Now, I want to come to the last point that I wanted to make, which is that having given such an aggressive, coordinated policy response, does this mean that our fundamentals have weakened or our vulnerabilities have risen? And the answer to this is no. And I want to answer it in one particular context, which is the reserves of a country, because they are a key measure of the external vulnerability of a country. We started this last fiscal year, meaning our level of reserves was on 30th June 2019, was $7.3 billion. Now, over the course of the year, there are inflows and outflows from reserves. And one key source of inflows and outflows is the new borrowing done by the official sector. And a key source of outflows is the debt repayments that have to be made. The balance of all of these in the course of the fiscal year was slightly negative. On net, we had to make slight repayments, net repayments on our obligations. But at the same time, due to the considerable improvement in the current account and the successful transition of the exchange rate system to a market-based system, we were able to build reserves significantly during the fiscal year. And this allowed us to end the fiscal year with reserves of over 12 billion, or an improvement of about 5 billion, not due to borrowing. And neither is this improvement due to portfolio inflows, because they came and they left. So in other words, this was a high quality improvement in our reserves. Another key metric of the improvement in our reserves is to also look at our forward liabilities, which stood at $8 billion at the beginning of last fiscal year. We ended that year by having reduced them by slightly over 2 billion. So in total, our net reserve buffers have actually improved by $7 billion of high quality dollars despite COVID. And that's why I say that because our fundamentals are in a reasonably good shape, the economy is well poised to recover. And I want to just end by the importance of reserves. This is a long time series of the reserves of Pakistan's central bank. And you will see it has had its ups and it has had its downs. I want to now superimpose on this what happens when reserves are either low or they fall. And what happens is that we have to repeatedly go to the IMF. And this shows in shaded gray all the periods when we have had to resort to go to the IMF. And you will see each time when our reserves are low or they have fallen sharply, what comes next is an IMF program. So I want to end by saying that our reserves having risen, other indicators of our vulnerability having fallen, means that we are well poised for the recovery. And that if we continue to build and preserve our reserves together with the other important structural reforms that need to happen, many of which are being led by Dr. Ishrat, we are confident that we can look forward to an optimistic economic future. Thank you.
Thank you so much, Dr. Azabakir. I think that's actually a great transition to our next question. Next, I would like to go to Dr. Ishrat Hussain. Dr. Ishrat Hussain, you have led the development of the government's comprehensive strategy to tackle the crisis. Some of the highlights include the country's largest unconditional cash transfer program, SME relief packages, revival of the agricultural sector, and trying to attack unemployment by incentivizing sectors like construction. So I have a two-pronged question for you. My first question for you is, what have the key principles of this strategy design been so far?
Well, thank you very much, Usman. It's always a pleasure to be at the Harvard-Pakistan Forum. I miss the personal interaction, which I enjoyed every year. And thanks, Reza, for your kind words. Now, the strategy which we adopted has to be seen in the larger context. And I won't repeat what Reza pointed out to you, that we inherited an economy where the aggregate demand far exceeded the productive capacity of the country. And therefore, we had high foreign borrowing, which cemented the gap between the demand and the supply of the economy. That means that our external debt to GDP ratio was pushing forward, and our external debt servicing as well as domestic debt servicing was creating a major constraint on our fiscal policy. On the top of that, the COVID also reduced the external demand because there was a withdrawal of economic activity in our trading partners. Therefore, on the top of this contraction, which we imposed through the stabilization on the aggregate demand, we also faced an external constraint as the demand for Pakistani products declined due to the slowdown in the economy of our partners. So under those circumstances, we had to prioritize. Our fiscal deficit was already 8 to 9% of GDP, so that was the constraint under which we had to work. But we also had to coordinate with the State Bank of Pakistan so that both the fiscal and monetary policy levers are moving in the same direction. So what was our priority on the 1.2 trillion rupees package? Raza has already pointed out 1.4, which the State Bank was able to do. So together, this is about 6.5% of GDP, which we provided for economic stimulus. So we had to prioritize. The Prime Minister was very clear, and he told the cabinet that we have to protect the poorest of the poor who are unable to find any cash support for even 2 square meals a day. And fortunately, we have a very sophisticated socioeconomic registry where we have a complete data of all the households according to the poverty scorecards. So 5.2 million households, which means more than 30, were already enrolled in the socioeconomic registry. But our target was that we should reach out to 16 million households. So they will be above the 16 poverty scorecard. And because the socioeconomic registry can only accommodate more than 5 to about 8 million, so we increase the threshold level, and people earning 25,000 rupees per month were also given the cash transfer. So that raised it to 8 million. But there were people who were unemployed, who had lost their jobs because of the corona, and we had no database for them. So we asked for a SMS invitation that you give your CNIC, give what you were doing, and then we had some filters. We used the NADRA database and did some data analytics. And by process of those filters, we were able to increase another 3 to 4 million households into the cash transfer scheme. And the fourth was the SME sector, where again, we wanted to ensure that the SMEs don't lay off their workers, especially the daily wage earners who only rely on their daily income in order to sustain themselves. So by now, out of the 16 million, our target, we have reached 15 million households, which is 19 million individuals in Pakistan who were below the poverty, at the poverty, and also what I call as temporarily displaced and dislocated because of the corona. And we have dispersed 175 billion rupees so far in a very short period of 3 to 4 months in a transparent, in a predictable manner. And this kind of cash assistance program has not even been challenged by the great opponents of this government, because there was complete transparency in this process. So we're very proud that we were able to contain poverty and unemployment by providing this cash assistance. Our second pillar was to focus on economic levers, which we didn't want to, lose sight of. So the export refunds had been a major liquidity crunch for our export sectors. And we tried, through the economic stimulus package, tried to give 100 billion rupees of past accumulated arrears to the exporters so that they can continue to have liquidity in order to carry out their own businesses. And I'm so glad that that particular strategy has worked out. While our neighboring countries registered a decline in their exports during the month of July, Pakistani exports went up to 5.5% positive growth rate. And all indications are that in coming months, in August, September, we have got the orders and the exports will pick up, which will further bridge and reduce the gap between our imports and exports. The third element was that agriculture is the backbone which employs 40% of our people in the labor force. So we gave a package of another 100 billion rupees in order to provide subsidies on fertilizer, pesticides, seeds, so that the farmers can sow for the next crops and they will continue to earn their livelihoods through increased productivity. So that was the strategy, a three-pronged: protect agriculture, which has an outreach of 40% of labor force, protect and help the exporters so that we have the foreign exchange earnings, and look after the poor and the lower income groups. So that was the strategy for the COVID.
Thank you, Dr. Ishrat Hassan. We would like to quickly follow that up with another question. We know it's early days so far, but which of these responses have been most successful and why?
This strategy has allowed us to open up the economy. There are countries which had complete lockdown, and our neighboring country, for example, had the poverty incidence going up during the lockdown because all the daily wage earners had migrated to their villages and they faced a lot of economic difficulties. But in our case, we were able to avoid that tragedy, and we were able, therefore, to gradually open up our economic activities. And one of the reasons why we are optimistic about the impact of this strategy is that we negotiated with the IMF for an incentive package to boost our construction industry. And as you know, construction industry is more labor intensive compared to the other industries. And it is also the spillover effect, both the backward linkages as well as the forward linkages with 40 different allied industries. And if you look at the July figures of cement, for the first time, cement sales have gone up by 20-25%. And that is a leading indicator. And you will see that steel, the paints, and other allied industries will create momentum in the economy and give boost to the economic growth rates. So that is the impact which we feel that our strategy has helped us overcome.
Shahrukh, you're on mute.
Okay, still learning. Thank you, Dr. Ishrat. Now we switch to Mr. Adnan. Mr. Adnan, an instinctive response to a crisis such as this one can mean people becoming more reluctant to save for the long term. Now, this on the back of Pakistan's already low levels of private savings may be a worrying trend for asset management companies and mutual funds. So I have a two-pronged question for you. If maybe you could spend a few minutes addressing the first one, if you can comment on any mindset and behavioral changes that you are seeing amongst your customers.
Sure. So first of all, good morning, Cambridge, and thank you, Harvard Pakistan Forum. I think since my both fellow panelists have commented on each other, I should not be left behind. For all the audience, first of all, Raza is a classmate from Harvard, so I think that's pertinent to note. But also equally importantly, Dr. Ishrat is a large reason why I'm part of the team and involved in the public sector. So very glad to be on this forum. Coming back to your question, I think conventional wisdom, yes, would suggest that in a time of crisis, when people might have fear of losing their employment, when future looks very uncertain, savings may trend to go down. However, in Pakistan, I can share with you a couple of statistics and then suggest to you why I think this is the case. Both banking deposits and funds into the asset management sector have actually grown significantly in the last 6 months. So banking deposits from December to now are up 15%. And the AUMs in the asset management industry are up about the same, about 14%. And I think there's a couple of reasons for that. I think at the high end, so you have high net worth individuals who would have been spending their money in terms of travel, in terms of luxury spend. All of those avenues have, of course, stopped due to COVID. And so that disposable income is flowing into what I would call forced savings. The other factor, I think, I would allude to what Dr. Ishrat said. I think the government's policy towards agricultural income has been highly effective. I think the support price mechanisms, coupled with the fact that these have been distributed over a much wider range of stakeholders. So rather than going to 20 mill owners, this time around, what we have seen is that the small farmer has actually benefited. So agricultural income has remained high during this period, and therefore rural deposits, again in the banking sector and some, of course, in the asset management industry have seen growth. And I think the third reason is what Raza alluded to. I think that the swift policies of the central bank in terms of supporting employment have meant that you have not had large-scale layoffs. You've had the employment has remained steady. People have had a paycheck coming in. And therefore, you've seen a continual of savings. In fact, the mindset firstly has actually changed because there is global uncertainty. People have felt that they need to save for a rainy day, which they actually see very clearly on the horizon.
Oh, okay, that's very interesting to note, and thank you for sharing those points. I think just to follow up on that, on the mindset changes that you're observing amongst your customers, how are you and how are asset management companies and mutual funds responding to this crisis or opportunity, and will there be a change in a mix of asset classes you invest in, and why?
So again, I'll refer back to the commentary that the governor was giving earlier on in this discussion. Pre-COVID, we were in a high interest rate environment where most of the savings were being channeled towards fixed income securities, mostly government backed, whether they were Pakistan investment bonds or whether they were treasury bills. However, with the swift reduction in interest rates, and a couple of other administrative changes led by the economic team, such as pension funds no longer being allowed to invest in the national savings schemes, we are seeing both short and long-term money now flow into the more core financial markets and equity markets. It's, I think, also very important to set for the audience reaction of our equity markets to, to the economic decisions that have been taken by the government and I think my fellow panelists. I think stock markets, as you know, are leading indicators, and I think that could not be more true than what we have seen in Pakistan. And it reads quite impressively. March to now, our stock market is up 50%, which is at par with one of the best with the Dow or other leading markets. In July alone, we are up 14%, which makes us globally the best performing market, and this is in dollar terms. Our average value traded, which was as low as $46 million back in March, is now about $150 million of value traded. So these are numbers that suggest that there is significant interest in our equity markets. But what is especially encouraging to note, and this leads to Dr. Ishrat's point, that most of this is through domestic resource mobilization. We have not seen the emerging market inflows that perhaps other emerging market inflows have seen. However, our outflows seem to have certainly slowed down. Most of our investment has been through domestic resources, and that is largely due to the buoyancy that we are seeing now in the cement sector, in the steel sector. Large-scale manufacturing is back up again in July. And so I think it is the local business community that is demonstrating its confidence in the measures provided by the economic team. And I think that is far more sustainable for any equity market than having hot money come in and out. I think that's an excellent sign. So with the performance of the stock market, we are certainly, as asset managers, this year around, we are actually seeing a lot more interest in our equity portfolios as opposed to the fixed income, since interest rates are down. And I think that is good for economic resource mobilization. We've already had 2 IPOs in the last 6 weeks, so it was the beginning of our fiscal year, both heavily oversubscribed. I know that there are about 4 in the pipeline already. So these are all good signs.
Thank you so much, Mr. Adnan Afridi. With that, we would like to segue on to the next portion of our panel, where we discuss the economic outlook and what we expect the next couple of months to look like. In this portion, I would like to start off with Dr. Ishrat Hussain. Dr. Ishrat Hussain, what kind of recovery are you realistically expecting the economy to see, and why? A V-shaped recovery, a U-shaped recovery, or an L-shaped recovery?
Well, you know, economists are very bad at forecasting. You know, if they were good at forecasting, they will all be millionaires. So let me start with that caveat. My own understanding at this moment is that on the external side, we have to watch very carefully how rapidly the advanced countries are able to revive their economies and create demand for Pakistani goods and services. That, on the external side, is the major constraint. Although we are very much close to China and we have a free trade agreement, but the demand in China has also come down from what its average was during the previous 5 years. So that is a constraining factor. But I'm also optimistic because the demand contraction will take place at the higher end of the goods and services, like the luxury, hospitality, travel, Louis Vuitton and all kind of fashion goods. Pakistan is still producing the low end or some middle end goods, and demand for them, I don't think is going to be contracted so much. So that's the reason why I'm a bit optimistic that despite the IMF and the World Bank's warning that global economy is not going to do so well, I would like to differentiate by creating a niche for Pakistani goods and services. Our exports for IT, for example, this year have actually gone up by 20%. For the first time, we have crossed to 1.3 billion. And because there are a lot of demand for e-commerce and online services, and we are low-cost producer of those services, I think we will be able to do well in the services sector, particularly the IT sector. So to that extent, that is my assessment on external. The domestic side, we have two major constraining factors. One is the pricing of our energy, which is outrageous as far as our industry and our exports are concerned. We would like to bring down the circular debt and also the cost of distribution and generation so that we can become competitive with our regional neighbors. That is a big challenge for us. And right from the PM to everyone is seized of this problem and trying our best in order to come to handle with this question. My second constraint is the FBR and the domestic tax collection has not even surpassed 10% of GDP. It is one of the lowest. So we are trying to make reforms not by changing the tax rates and penalizing the existing taxpayers, but by using automation in order to integrate the various databases and broaden our tax base. So we can have more taxpayers and therefore the tax collection is not at the expense of the existing taxpayers, but hopefully by broadening the tax base, we will increase our collection, but also insulate the existing honest taxpayers. These are our two challenges. If we are able to come to grips with them in the next few months, I can see that by 2023, Pakistan's economy can reach about 5% per annum growth rate. If I look at from the agriculture, industry, and services decomposition, that is my view. Therefore, my bottom line is that we are going to see hopefully a V-shaped recovery rather than a U-shaped or L-shaped.
Thank you, Dr. Ishraf Hussain. Now, I would request you to think more about the long-term horizon going past 2023, the next 10 to 20 years. What are some structural improvements or damages that you see due to COVID-19?
Well, my pet hobby, and that's my research also, had convinced me that unless we repair our institutional framework for delivery of goods and services in this country and make our industry and agriculture competitive, we are not going to be on a upward sloping curve. We would have booms and busts. And when there are busts, we have to go to the IMF, where means that your economy is under treatment of a medical doctor, and you have to take their advice. In order to get out of that, we have to do structural reforms in energy, in taxation, in our local government systems, and in our privatization of the state-owned enterprises. If these four elements are fulfilled, successfully, we will be able to have a smooth, gradual upward sloping curve. And I give you the example of 2000 to 2007. We tripled our FBR revenues because we reformed the FBR. We doubled our exports because we took out incentives for exports and anti-export bias was removed. So we have the anecdotal evidence of 7 years where we could do these structural reforms, but they were then disrupted. And the local government system in 2000, 2007 was able to take the delivery of services, education, health, drinking water at the doorsteps of the ordinary citizens without any intervention. So those elements have to come into play, and that is a big challenge for all our countrymen.
Thank you, Dr. Ishrat. I think for Dr. Raza Bakir, Dr. Bakir, what kind of policy responses can we expect from State Bank if Pakistan is able to sustain the reduction of spread? And what can we expect if cases surge again?
Thank you, Shahrukh. I should first say that I echo many of the things that Dr. Ishrat and Adnan said earlier. Now, with regard to your question, a central bank should always be very careful in its communication and not reveal everything that is in its war chest, because you need to tailor your responses to all the information that you have available, and you want to keep your powder dry. And sometimes the markets can get ahead of you if you say too much. So I am, for the sake of the nature of the job, not going to be able to share too much by way of specifics, but I can tell you how we are thinking in the State Bank. And how we are thinking is, first of all, domestically, let's assume that cases continue to come down. We are looking at where and when support might be needed, if further support is needed. And as I mentioned to you earlier, we have given a lot of liquidity relief, including through principal extensions. But at the same time, there is going to be a deterioration in the asset quality on the bank's balance sheets. It's natural when you get such a big real and financial shock. The question is how much? And that is something we are monitoring very carefully. And right now, we feel quite comfortable because our net NPLs, our non-performing loans net of the provisions that banks have, is less than 2%. It's a comfortable level. Because we stopped dividend payments while we see the impact on banks' balance sheets, our capital adequacy ratios are above 18% on average. But it's an area that we want to watch very carefully and ensure that there is no doubt that anybody entertains in their mind about the stability of our financial system. So we continue to monitor that. We continue to monitor the real sector very carefully as to see which sectors the recovery is taking place, which sectors we may need to take any further action. But we're also keeping an eye on the external markets because, as you know, COVID was the mother of all external shocks. It was not because of anything Pakistan did. In fact, Pakistan was humming along on a very nice trajectory when COVID struck. So we have to keep an eye on the global financial markets. And recently, even if you look at the last 12, 15 years, global financial markets have surprised all policymakers by how quickly they can unravel. We had the global financial crisis when everybody, was glued through their Bloomberg screens, looked like there would be no floor, things kept on falling. And now we've had COVID. And we have to watch out if there may be further turmoil. And we have to watch out for another aspect, which is that if cases continue to come down and eventually advanced economies begin to withdraw the unprecedented monetary stimulus that they have provided and they begin to raise global interest rates, what will be the impact on emerging markets? Last time around this happened, was called tapering. That incident was referred to as the taper tantrum, when emerging markets all began to express their great anxiety when global interest rates rose and capital flew out of emerging markets. This time around, once they begin to raise global interest rates, we may deal with the mother of all taper tantrums. So we have to be prepared. And as I mentioned in my slides, one of the best ways of preparing, building a war chest, and I showed you that our reserves, both in terms of gross reserves as well as in terms of our liabilities, have improved. So we think we have a good war chest. We'll continue to build it so that we can deal with any such risks if they materialize. And if we have a resurgence of cases, then we will have to see whether any further support is needed. But I just want to say that, the economic crisis is secondary. This COVID is first and foremost a public health crisis. And until the public health dimension is addressed, we will not be out of the economic situation and crisis that we have.
Thank you, Dr. Bakir. That was very helpful to know. And I think maybe now the second question is very similar to what I think what we asked from Dr. Ishrat is, as an economist and as governor, what are some structural improvements or damages that you are seeing due to COVID-19 specifically?
All right, I will not use the word damages, but let me characterize it as what are some of the challenges that have arisen and what are some of the good byproducts that have come about because of COVID. I think in terms of the challenges, the first is what I would call a narrative disruption. Pakistan was in the midst of telling a good story to historically skeptic, domestic, and external audiences. Okay? And this story was about beginning to decisively tackle our twin deficits, the current account and the fiscal. And before COVID, Bloomberg was calling Pakistan stock market one of the best performing stock markets. Capital was flowing in, and some real economy indicators were also beginning to improve. And so there was a narrative which was getting going. And so the first, I think, disruption or challenge that has occurred is the narrative disruption and how we have to put that narrative back. First of all, through appropriate policies, but also through good communication. So that's one challenge that has arisen. The second challenge is, I think that COVID has necessitated a response, a fiscal response as well as a monetary response. And we already had a high debt to GDP ratio to begin with. And now because we have not been able to reduce the fiscal deficit at the pace that we wanted to, and growth is less than what we previously anticipated. Well, in the debt to GDP ratio, our numerator has become slightly worse because of COVID, the debt level, and our denominator, which is growth, is a little bit less than what it would have been. So on both of these counts, our debt to GDP trajectory is a little bit higher. There is absolutely full confidence in ourselves as well as confidence manifested by international financial institutions that we will be able to bring this down. But it is one of the challenges that has become a little bit more because of this external shock. The third challenge, which so far has not materialized, but one that we need to keep our eye on, is remittances. If advanced economies have a prolonged contraction in their disposable incomes, they're going to have less need for many of the Pakistani workers that are in many such countries. There are already problems in the Middle East. The US is in the midst of a second wave. So we have to monitor this very carefully. So far, we have not seen a noticeable reduction in our remittances number. And in fact, we are reasonably confident that the remittances number for next month is going to not disappoint. But it is something that we have to keep a close eye on. Now, what are some of the positives that have emerged? And I think one, at an institutional level, picking up on what Dr. Ishrat was saying, is greater interagency coordination. COVID, because it was such an acute crisis, has forced, in my view, more and better coordination across all the different parts of the public sector. And that's a good. And if it can be maintained, I think it's going to lead to better and better economic policy decisions and coordination. I think another potential positive that is emerging is the diversification that multinational companies are doing because of the global supply chain disruption. Because, of COVID, and because some countries that are more open than Pakistan in their exports and imports have been affected more, international global firms are looking to diversify their manufacturing bases. Pakistan stands to benefit from this because Pakistan is not that well integrated in global value chains. And therefore, if some volume, some production that was going to go to some East Asian country comes to us, that's helping. And we are seeing that. And our textile exporters informally share with us that their exports in some areas, such as home linen and similar areas, are back up to 100%. In fact, in some cases, are above pre-COVID levels. So I think that's another hidden positive that is beginning to emerge and something that perhaps could help us in the times to come.
Thank you, Dr. Raza Bakir. With that, we'd like to go to Mr. Adnan Afridi. Mr. Adnan Afridi, in the next couple of years, do you see an opportunity for Pakistan to at least slightly transfer its focus from consumption to investments or savings? If not, then how can we achieve this outcome or encourage such a behavior?
Yeah, so I think, building up to, some of the things that Raza has said, one of the reasons why we have been a consumption-led economy has been because of some of the policies that prior governments or the central bank have had. So we've had an exchange rate which was not appropriately aligned with the real value of the rupee. We had interest rates which were not aligned, and therefore people had cheap money when in times when they should not have had cheap money, and I think that has changed. So with an appropriately valued currency and with appropriate amount of money in circulation, we are now seeing a trend for people to be saving where they should. Having said that, I think savings ultimately is a function of, frankly, of people's having disposable income, right? So when you have disposable income, then people tend to have the ability to save part of it. That comes in turn from an appropriate level of economic growth. I think one of the offshoots that we've seen in the recent sort of buoyancy in the market, again, and I want to credit, I think, the government for this, is that just like we've had what this terminology of smart lockdowns, we've also, I think, had smart targeted economic measures that have taken place. So this construction package that Dr. Ishrat talked about, I think that this has the potential to really start freeing up the economy. I've already seen, he mentioned cement. I was just recently in a bank meeting, and where we saw offtake from consumers linked to the construction industry seeing significant increases. And I think that is going to lead to people's disposable incomes going up, which in turn is going to lead to them being able to save more. Having said that, I think I want to also touch upon one of the challenges which I think so far my panelists have not mentioned, which is, I think, Pakistan's power sector. I think this requires some immediate attention, because this could be a barrier to our economic growth in the near term. We've got anecdotal evidence already that we have expansions which are getting hindered by not having appropriate energy in place. And I think given the benefit that Pakistan's export sector is currently getting from the US, China, trade war and India and Bangladesh not being able to capitalize from it, Pakistan is actually for the first time in a unique position to actually benefit its export sector substantially. And one of the caveats to that is an urgent reform to the power sector. So I think to some of the points that Dr. Ishrat and Raza mentioned, I would add the list of challenges and need for attention would be the power sector to try and take advantage of the next 18 to 24 months, which is the timeline that you're talking about.
Thank you, Mr. Adnan Afridi. Now looking at it from a really high level lens, how do you see the performance of the Pakistan Stock Exchange playing out in the next couple of months?
Well, I think there again, I will take Raza's cue and perhaps not get into specifics. That would not be appropriate for someone in my position. However, I think what I can lay out for you are I think, the drivers. So a low interest rate environment, real economic growth, which we are seeing, whether it is in the listed sector, that is, so whether it is cement, steel, large scale manufacturing, agriculture, a predictable exchange rate. I think these are all ingredients for sustainable growth in the equity markets. We are seeing both, as I had mentioned, both long-term and short-term capital flows coming into the market. And so I think that would be, I think for this audience, I think that should be a sufficient indicator to see where this market could be trending over the near term.
Thank you, Mr. Adnan Afridi. With that, we would finally like to shift to the last portion, the final portion of our panel, which is the question and answer session. I would just like to say here that we've obviously received a lot of questions, around 50. Because of time constraints, we won't be able to address all of them. However, we will make sure that the questions are shared with the panelists and relevant authorities, just so your views are heard. The first question we will be taking is Bahemant Bharta Chakravarti. The question is, how will COVID-19 affect the terms of debt of CPEC? Prime Minister Imran Khan has said that Pakistan is on track to pay back debt. Is that assuming unnecessary fiscal stress in what could be an opportunity to renegotiate? I would, if it's fine, I would like to direct this question to Dr. Raza Bakr.
Usman, thank you. But I think as representing the central bank, I may not be the best person in this forum to address the question, and Dr. Ishrat might have more views on it. So I'm going to address the concept and the underlying question of debt sustainability broadly. And if Dr. Ishrat has specifics on CPEC, perhaps you could turn to him next. But where we stand, have a debt to GDP ratio and gross financing needs that are considerably less than emerging markets who have had distress, debt distress. Obviously, it's on the higher side, but with the outlook that we have together with the COVID shock, we are quite confident that, as I mentioned earlier, this debt trajectory is decidedly turning downwards. And I want to draw your attention also to the fact that this is not just our analysis. If you look at the last IMF report, at the time they gave us the $1.4 billion under the rapid financing instrument, when COVID had already stuck, and when they had already reduced their growth projections, you will also see that they also project a debt trajectory. And whether it comes from CPEC or from other sources, debt is debt. They also project a debt trajectory which is decisively coming down. Now, that's number one. I think number two, in terms of addressing this question, is that we have also been quite transparent about our debt statistics. And from some quarters, there are always questions about the obligations to China. And we publish all our debt obligations by creditor. And they are available through the government's websites. They are available in the IMF staff report so that people can see who we owe and how much. And we believe that such transparency helps to raise the confidence of the people in Pakistan. And the last thing I would say is that we, regarding the point about the ability to service debts, whether it's to China or others, IMF never lends if it has any concerns about debt sustainability. And IMF has just recently given us the RFI. And that partly is also a signal about the fact that together we have a package of economic policies that is addressing the underlying problems that we have of the fiscal deficit and the current account deficit. So I'll stop there. And if I don't know if Dr. Ishrat wants to get into some of the CPEC specific terms and what the government may be looking at in terms of dealing with those.
Dr. Ishrat, you're on mute, I think.
Yeah, can you hear me now?
Yes.
I just want to play some facts. I will be brief. Out of $27 billion under CPAC, we have only $5 billion as debt from the government of China or the Chinese financial markets. And 4 billion is the commercial borrowing, which has nothing to do with the CPAC. Most of it is the foreign direct investment, which is paid by the private companies. And going forward, we are going into the special economic zones where the infrastructure is being built by the government of Pakistan, and the private companies from China and anywhere in the world will be setting up their own industry. So there is no future debt trajectory for CPAC. So all these illusions about CPAC, as Raza pointed out, are totally misplaced because the IMF has taken into account each and single penny of debt. 10% of the total external debt of Pakistan is owed to China, 40% to multilateral institutions like IMF or Bank, 40% to bilateral countries, and 10% to commercial.
Thank you, Dr. Ishrat. I think we have another question. Perhaps both Dr. Baki and Dr. Ishrat could take a crack at this. It says, what does the recent rift with Saudi Arabia over Kashmir and the recall of the loans and oil deal mean for the Pakistani economy? And does this translate to an increased dependence on China? Dr. Ishrat, maybe you can start.
Okay. Look, we are very friendly with Saudi Arabia. Saudi Arabia provided us liquidity support even before the IMF program, which was very helpful to Pakistan's balance of payments. They also gave us a deferred line of credit for oil payments. Because of the internal financial difficulties, Saudi Arabia, because of the oil price decline, is facing fiscal problems. So they asked for the $1 billion, which was deposited in the State Bank of Pakistan, to be repaid. And that's what we have done. But this is not confined only to Pakistan. They're asking other countries also, which had borrowed or had the deposits, to repay them. So people should not see a lot of mischief in this particular transaction. This is their money. And if they want their money, they're most welcome to get it.
Sounds good. With that, we will move on to our next question, which is for Mr. Adnan Afridi. I would assume, Mr. Adnan Afridi, if you could just tell us what enabled the Pakistan Stock Exchange to outperform neighboring markets, and register again in fiscal year 19 to 20, despite the impacts of COVID-19. Does this foreshadow a bright future for the Pakistani stock exchange in comparison to the neighboring countries?
So I think it's a function of two things. First and foremost, as Raza had earlier pointed out, COVID is primarily a public health crisis, and I think Pakistan's response to that public health crisis has been more effective than some of our neighboring countries, as the statistics would show. So whether it is of course in the incidence of the disease, or whether it is in how many days a particular sector was closed, I think we have managed to keep a balance between keeping the economy running and of course keeping the health of our people in as a priority. So I think Pakistan, of course, and I think this is globally recognized now. I saw that Bill Gates has made a comment on this, I believe yesterday, and so have others. So I think that is the primary reason why our stock market, being a leading indicator, has responded and reflected that. The second, I think, primary reason for this is that our key listed sectors have rebounded. So, you talked about the alphabet soup, whether it's a U shape or a V shape. And I think it depends on the sector, of course. But I think some of our key listed sectors have been the beneficiaries of the economic responses that the central bank and the economic team in Islamabad have led. So again, when it comes to the construction package, which has had a direct linkage to our cement and steel sector, whether it comes to, well, our banking sector has been robust, of course, throughout, whether it comes to the agriculture sector, some of which is listed, we have seen a very sharp rebound post-March. So I think it's a function of both. It's a function of companies actually delivering good results despite COVID. And I think it is the public health response of our government with respect relative to neighboring markets. I had already mentioned in my earlier comments that Pakistan has been a key beneficiary of the global trade war that is going on. I have anecdotal evidence that our textile exports in particular are seeing significant uptick in their order book relative to Bangladesh and China. And all of that, of course, translates the bottom line of many of these, which are listed companies. And so a stock market is, of course, just a manifestation of
Thank you, Mr. Adnan. I think the next question from the audience is perhaps directed for Dr. Bakir. Question is, how will the State Bank ensure that the current account surplus does not turn into a deficit once the economy starts growing again, given an expected increase in oil imports and increase in imports of capital equipment?
Okay, so let me try to address this question by first pointing out that the overall concern that a policymaker has is with what economists call the balance of payments. And the balance of payments is the net account in terms of foreign exchange transactions between a country and the rest of the world. The balance of payments has two key parts to it. One, which is called the current account, which broadly is the trade in goods and services. And the other is the capital and financial account, which broadly is the trade in securities, financial assets. Now, just a current account deficit by itself is not a problem if there is significant inflows on the capital and financial account. Okay. So the first thing we have to understand is that a current account deficit by itself does not mean that there would be problems. Now, why would the capital account and financial account turn into surplus? Why would money come in? It would come in for the reasons that Adnan was mentioning, which is that the financial markets, which are often a leading indicator of real activity in the country, are already demonstrating optimism in the future. Pre-COVID, you saw this. You saw the stock market doing very well. And then the real economy began to pick up. And now you're seeing the stock market recovering having recovered very quickly, as Adnan pointed out. So that would be one of the many different reasons, but there are other much more important reasons, which would be foreign direct investment, for example. And that in a way is much higher quality capital and financial account inflows. So the first point is that a small current account deficit is not a problem by itself. I think the second point that I want to make is you saw the drastic reduction that has taken place in our current account. And it was at a peak of $2 billion. It came down to 100, 200 million. That's a tenfold reduction. And the key reason why the current account deficit swelled to historically unprecedented levels was an overvalued exchange rate, which in turn stemmed from a fixed exchange rate. Since we have, as part of the reforms that we started in June, transitioned to a market-based exchange rate system, that by itself ensures that we would avoid situations where the exchange rate becomes overvalued significantly and thereby impedes the current account, thereby promotes imports over exports. In all those years when there was an obsession with keeping the exchange rate at a particular number, what was actually happening in the country was that it's a tax on exports. And the same people who used to invest in export-oriented sectors were investing in domestic-oriented sectors, consumption-oriented sectors. And because we don't have that exchange rate regime anymore, we have the exchange rate as a buffer, and responding to market forces doesn't really mean also that there is no room for intervention. As we have stated many times, if there are disorderly market conditions, the state bank does stand ready. But the final point I'll make is that our exports right now are actually reasonably well primed to benefit from a global recovery. Dr. Ishrat mentioned that the contraction is on some higher end products, and like say, Louis Vuitton or others. And Pakistan is not in that segment. Pakistan is in another segment. But at the same time, we have some new areas where we are observing growth in exports. And that sustaining that export growth, such as IT services or others, will be another reason why we could have other new sources of export growth. To this end, one of the measures undertaken by State Bank recently and before COVID was that while previously State Bank's schemes, concessional credit refinance schemes, which were primarily available to just 5 export-oriented sectors, the usual ones, textiles, leather, a few others, we opened it up to any sector which can demonstrate that it can grow its exports. So now it doesn't matter what sector you are in Pakistan. If you have an idea, it's an economically, financially viable idea, you believe you can grow exports in any sector, and if a bank lends to you on that basis, you can qualify for that concessional credit. And we are trying to promote the emergence of new export sectors so that our export base is also more diversified. So, because of the combination of these factors and because our outlook for growth is still quite modest, we are quite optimistic right now about the outlook for the balance of payments in general, but also in particular for the current account.
Thank you, Dr. Bakir. I think the next question is perhaps for Dr. Ishrat. So when making liquidity support decisions, how do authorities decide which businesses to prioritize?
No, I think we're not choosing firms or the sectors. We are trying to do a regulatory guillotine, which is applicable to all firms, small, medium, large, across all sectors. There are many superfluous and redundant government regulations which need to be completely weeded out because they add to the cost of doing business and make us uncompetitive, but also they create rent-seeking activities by the regulators. So what we are trying to do under our regulatory guillotine elimination program, which is being supported by the World Bank, is that we are looking at the federal government, the provincial government, and the local government, and say, you do not require prior approvals, clearances, and no objection certificates in all cases. Here are some cases where you can ask for prior approval. But in most of the cases, you should go for ex post compliance, whether you are complying with the regulations. 95% of the people who are complying do not have go through that same rigmarole of filing a heap of papers which go into 7-8 pages just to get a permission. The second point we are doing is to using automation. For example, the Pakistan single window, which is now going to be a portal for all international trade transactions, would have the banks, the logistics companies, the plant quarantine, the civil aviation, all 70 agencies. You don't have to run with the papers to each one of the agencies. You file your paper into the portal, and the back end, those are distributed among the agencies. They will give clearances within a period of time so that the cost of doing business, which is $400 per transaction, will be reduced to less than $100 or $55. So these are the two ways, automation as well as the regulatory guillotine. So we're not choosing firms, we're not choosing sectors, but we're trying to create a level playing field for everyone to compete both domestically and internationally.
Thank you, Dr. Shafsan. I think we have time for one last question. The question is from Ibrahim Khan. After tremendous growth for several years up to 2018, Pakistan's tax collection has been lackluster in the last 2 years, even pre-COVID. What can be done to improve our revenue collection? I guess if that's fine, I would like to direct this to Governor Bakr and Dr. Shafsan.
Sure. I would just like to, first of all, take issue with one part of the premise of the question, which is that the tax collection performance was lackluster pre-COVID. And that is inconsistent with facts, because if you look at FBR revenue collections year on year, as the fiscal year began, you actually saw tax collection growth well above 20% in the middle of the fiscal year. That's well above nominal GDP growth rates, and that was leading to an increase in the revenue to GDP ratio. So I think I would, first of all, want to clarify that. And in fact, that was also one key reason why the primary balance had turned into a surplus for the first 9 months of the fiscal year. One other thing I would like to mention, and I'm sure Dr. Ishrat will have many valuable insights on FBR reforms, which is one of the portfolio of responsibilities that he has. But one thing that I want to mention is an effort on the part of State Bank, which would help and complement FBR's efforts. And that is the digitization of the economy. We've been pushing and recently have published the National Payment Strategy for Pakistan, which was launched together with the President of the World Bank when he visited the State Bank just a few months ago. And that is an aggressive push to try to reduce the costs of people to access the banking system. And once they are into the banking system, whether it's small or medium players, and of course individuals, That greatly then improves the documentation of the economy, and then also facilitates the FBR to be able to bring new people into the tax net. And it's one area of complementarity between our work and FBR's work that I wanted to mention. Thank you.
Perfect. With that, I guess we've come to the end for this panel. I would like to apologize for not answering all of the questions. We received nearly 70 questions, but again, we'll make sure to share them with the panelists. We would again like to thank our panelists for taking out the time for this constructive discussion. The Harvard-Pakistan Forum team truly believes in making technical discussions like these on pertinent issues accessible to the public to better understand the world around us. We also thank you, the viewers, for taking out the time to attend this panel, and we really hope that you get a chance to also attend our remaining 4 panels over the weekend. With that, take care and Allah Hafiz.
Thank you.
Thank you.
Thank you. Thank you.
Thank you.